If you want to understand what is about to happen to debt, you need to stop imagining a politician erasing numbers on a screen. That is not how this game works. No one at the central bank is going to log into the Treasury S books and type 0. No one is going to open your mortgage account and wipe out your balance either. That fantasy is for people who like headlines more than mechanics. The real mechanism is quieter than that. It is more boring than most people expect, more political than most people realize, and far more profitable for the people who understand it before it becomes obvious. Debt is not usually destroyed by payment. It is destroyed by dilution. That is the mother line. The country owes too much, the payment schedule is getting heavier, the rollover risk is real, and once a government reaches that point, it only has a few paths left. It can tax harder, it can cut deeper, it can default openly, or it can choose the path governments always prefer when they still control the currency. It can let the dollar do the dirty work. That is what most people miss. The government does not need to repay debt with stronger dollars. It only needs to repay debt with legal dollars. If those dollars buy less by the time they are repaid, the burden has still been reduced. The number survives. The weight does not. That is the trick. And if you understand that trick, you begin to see something most homeowners still do not see. The same mechanism that helps a government shrink the real weight of its debt can also shrink the real weight of your fixed rate mortgage. Not because anyone is trying to save you, because you happen to be standing on the right side of the same inflation machine. That is the whole story. For years, people were trained to think about debt morally, pay it off fast, be clean, be responsible, get rid of every liability as quickly as possible. That advice sounds virtuous because it is simple. Simple advice sells. But simple advice breaks down when the monetary environment changes. A mortgage is not just debt. A fixed-rate mortgage is a contract written in future dollars that matters enormously. If those future dollars are losing purchasing power while your payment stays the same in nominal terms, the burden is melting in real terms every year. The bank still gets the number it was promised, but the number no longer means what it meant when you borrowed it. That is why I want you to stop looking at the mortgage statement as if it were the whole truth. The statement shows the number. Inflation changes the meaning of the number. That second part is where fortunes are quietly protected or quietly drained. I have always believed that intelligent investing begins when you stop staring at the number and start analyzing the system around the number. A dollar is not just a dollar. It is a unit of purchasing power moving through a policy machine. When that machine changes, every contract written in dollars changes with it, even if the face amount looks perfectly stable. That is what is happening now. The country is carrying an extraordinary debt load, but that by itself is not the real danger. The real danger is the refinancing structure around the debt. The debt does not simply sit there at one fixed cost for 30 years like an old homeowner loan. Large parts of it roll over again and again. Washington has to keep replacing old debt with new debt under whatever rate environment happens to exist at that moment. That means the federal government lives with a problem most homeowners would never tolerate. Its payment terms keep resetting. If rates are low, the machine breathes. If rates are high, the machine chokes. So what does a government do when the interest burden itself starts becoming one of the fastest growing expenses in the entire budget? It does not solve the debt the way a family solves debt. It solves the debt the way a currency issuer solves debt. It represses. That is the first mechanism I want burned into your mind. Financial repression sounds academic. It is not. It is one of the oldest tricks in sovereign finance. It simply means the system is arranged so that the return paid to savers stays below the actual rate at which purchasing power is being lost. The saver believes he is earning something. In real terms, he is often losing ground. Meanwhile, the debtor is allowed to repay obligations in money that has been slowly hollowed out. That is how debt gets eaten without public drama. The saver funds it, the borrower benefits, the government survives it. This has happened before. It happened after the Second World War. The country came out of that period carrying a debt load that looked suffocating relative to the economy. Yet the debt ratio did not collapse because Washington became morally disciplined overnight. It collapsed because growth, inflation, and policy design worked together to reduce the real burden while savers were quietly undercompensated. That is the historical pattern. Now let me show you why this matters for an ordinary homeowner in a way most financial commentators never explain properly. Imagine you borrowed $300,000 at a fixed mortgage rate around 3%. At the moment you signed that contract, those were relatively strong dollars. Every monthly payment felt heavy because the purchasing power attached to that payment was high. But over time, if inflation keeps running and your payment remains fixed, the economics start turning in your favor. Your mortgage payment stays still. Prices move. Wages drift higher. Rents drift higher. Nominal business revenue drifts higher. The cost of replacing the house rises. The real burden of the payment shrinks. The bank still receives the same nominal number, but not the same real value. That is your hidden bailout. It does not feel dramatic because it arrives as erosion, not as relief. Nobody sends you a letter saying, "Congratulations, your debt burden has been cut in real terms this year." The process is too slow for that. But slow does not mean weak. Slow means politically tolerable, and that is exactly why governments like it. It punishes the saver without calling it punishment. It rewards the debtor without calling it rescue. It reduces the real debt load without calling it cancellation. That is why I laugh when people speak about this as if it were some kind of secret mercy. It is not mercy. It is arithmetic with better public relations. Now here is where the identity flip happens. Most households still behave as if low-rate fixed debt were a stain on the balance sheet that should be scrubbed off as fast as possible. They are still operating with the old moral script. The old script says debt is the villain, repayment is the hero, and the faster you eliminate the mortgage, the more virtuous you are. That script can be catastrophically expensive in an inflationary debt repression regime, because if you are paying off a 3% mortgage aggressively while the system is inflating away purchasing power faster than that, you are effectively handing back strong dollars in a world that is trying to reward you for paying back with weaker ones later. You are volunteering to lose the advantage. That is the second mechanism. I call it the fresh dollar mistake. Every extra principal payment on low fixed rate debt has an opportunity cost. It is not merely a reduction in liability. It is also the surrender of a very unusual asset. And yes, I use that word intentionally. In the right environment, low rate fixed debt is not just something you owe. It is something you own. It is a contract that lets you repay tomorrow with money likely worth less than today. That is valuable. Now, that does not mean all debt is good. That would be foolish. Bad debt is still bad debt floating. Rate debt can become a trap. Consumer debt is poison. High interest debt should be treated like a fire, not like an investment strategy. But cheap fixed rate long duration debt attached to a real asset in an inflationary regime is a different animal entirely. That distinction is where intelligent people separate themselves from slogan followers. Once you understand that, you also start to see the losing side of the same machine. Every debt reduction system requires a payer. Repression is not magic. It does not reduce debt burden out of nowhere. It transfers wealth from one side of the balance sheet to the other. It takes from those holding money, like assets that do not keep up, and gives relief to those owing fixed nominal obligations, while holding or controlling hard assets, productive assets, or contractual advantages. In plain English, the grandmother with too much money sitting in a near-zero savings account is helping fund the rescue. The diligent saver who thinks a bank statement is safety is often subsidizing the borrower with a cheap mortgage, the owner of scarce assets, the operator of a cash-flowing business, and the person who understood the policy architecture 1 or 2 years before the public conversation caught up. That is not a conspiracy, it is the design. The third mechanism is what I call the leaking battery. Think of the dollar not as a piece of paper, but as stored purchasing power. If the battery leaks faster than the bank recharges it, the saver is getting poorer even while the account balance looks stable or even mildly higher. Most people never train themselves to think in real terms. They think in statement terms. They see more dollars and assume more wealth. That is one of the most expensive illusions in modern finance. If your cash yields 0.1% and your purchasing power is eroding at 3% or 4% or more, you are not preserving capital. You are liquidating it slowly while smiling. Meanwhile, the homeowner with the fixed mortgage is doing the opposite. He owes a fixed nominal stream while owning an asset likely to be repriced upward in nominal terms. Over long periods of inflation and currency drift, the liability weakens. The asset often reprices. That spread is where the quiet wealth transfer occurs. This is why the same people who preach discipline often end up on the wrong side of policy. They save the way they were taught to save. They trust the institutions they were taught to trust. They accelerate repayment because it feels responsible. And all the while, the system is rewarding exactly the opposite posture. That is the emotional cruelty of financial repression. It often punishes the temperament people associate with prudence. Which brings me to the fourth mechanism. I call it the two-road problem. From here, a homeowner has two broad paths. On the first road, he keeps obeying the old script. He accelerates the mortgage. He piles money into low-yield bank accounts. He treats nominal safety as real safety. He mistakes inactivity for defense. Over time, the machine harvests him quietly. Inflation drains his liquid savings. The bank keeps the spread. The cheap mortgage advantage gets surrendered early. He feels responsible the whole time. On the second road, he recognizes the regime shift. He protects liquidity, but he refuses to overfeed low-yield cash. He keeps the low-rate fixed debt in place. He studies where his excess capital should actually go. Maybe that means productive assets. Maybe it means hard assets. Maybe it means additional cash, flowing real estate. Maybe it means public equities with pricing power. Maybe it means building a stronger personal war chest. The details differ. The principle does not. Do not hand back your inflation advantage voluntarily. That is the road I prefer. Now let me be careful here because discipline still matters. I am not telling anyone to become reckless. I am not saying take on more debt just because inflation exists. I am not saying every homeowner should lever aggressively into the next shiny asset. That is how fools turn a structural advantage into a personal disaster. What I am saying is simpler and much more useful. Understand the regime before you follow generic advice. In a stable low-inflation world with normal real yields, one set of behaviors makes sense. In a debt-heavy inflation-managed repression world, another set of behaviors can be much more rational. That is why I do not trust one-size-fits-all financial morality. I trust arithmetic. Arithmetic says this: if your mortgage is fixed low and long, inflation is doing some of the work for you. If your savings yield is structurally below inflation, the system is taxing your liquidity without calling it a tax. If you accelerate payment on the wrong liability while leaving capital idle in the wrong asset, you can accidentally move from the winning side of the machine to the losing side with a smile on your face. That is avoidable. The fifth mechanism is what I call the homeowner protocol. If I were sitting in that situation, the first thing I would do is pull the actual mortgage terms and study them the way an investor studies a bond. Not emotionally, mechanically, rate, duration, fixed or floating prepayment behavior, refinance optionality, sensitivity to inflation. I would stop seeing the mortgage as a moral burden and start seeing it as a financial instrument. Second, I would compare the real return on my liquid cash to actual inflation, not to the comforting fiction printed on a bank website. If the bank is not preserving purchasing power, then I would treat excess idle cash as a wasting asset unless it has a defined emergency purpose. Third, I would identify which assets in my life benefit from inflation and which get quietly harvested by it. Fixed-rate debt can benefit cash. Heavy passivity gets harvested. Productive assets with pricing power can benefit weak fixed. Income positions often get harvested. The goal is to move from being the battery that leaks to owning the things that charge themselves. Fourth, I would stop taking financial advice from people who never explain who pays for the debt reduction. Anytime someone tells you a policy trend helps the economy, ask the adult question, at whose expense? That one question clears a lot of fog, because every real solution in finance has a loser attached to it. If government debt is being lightened in real terms, someone is absorbing that dilution. If homeowners are being quietly helped, someone is being quietly harvested. If savers are under-earning inflation, someone else is enjoying the subsidy. Once you understand where you are in that chain, your behavior improves immediately, and that leads to the final choice. You can live like the policy does not matter, or you can study the policy until you understand which side of the transfer you are standing on. You can keep seeing your mortgage as a burden to eliminate, or you can understand that under the right conditions it becomes one of the strangest gifts the system will ever hand you. You can keep protecting cash that is silently melting, or you can admit that not all liquidity is equal and not all safety is real. You can keep behaving like a saver in a world built to harvest savers, or you can start behaving like an allocator who understands the rules of the machine. That is the real difference. Not intelligence, not luck, interpretation, because the policy is not hidden anymore. The math is not hidden anymore. The mechanism is not hidden anymore. The only question is whether you will keep obeying advice designed for a different regime or whether you will finally build a strategy around the regime we actually have. That is where the real mortgage story lives. Not in cancellation, in dilution, not in mercy, in arithmetic, and not in whether the balance disappears. in whether the dollars you use to repay it are still strong by the time you send them.